The global digital advertising sector has seen extreme turbulence lately. Ad spend fluctuates wildly from quarter to quarter, and many major platforms are struggling to forecast their revenue with any certainty. Yet, looking at the Q4 and full-year results for Affle 3i Limited, you see an entirely different reality. They just closed out their 2026 financial year with a level of stability and scale that defies current industry trends. This chart shows their core metrics for FY 2026. Top-line revenue crossed 27.09 billion rupees, EBITDA reached 6.1 billion, and profit after tax hit 4.54 billion. Hitting a strong quarter is one thing, but maintaining that momentum over a multi-year timeline is the real outlier. Across all major metrics, revenue, EBITDA, and profit, Affle has sustained a compound annual growth rate exceeding 25% over the past 5 years. To understand how they maintain this trajectory, we have to pull apart the mechanics of their business. We will deconstruct their cost-per-converted user model and their strict vertical-specific client targeting to see exactly how this growth engine operates. In the consumer intelligence market, long-term value is awarded to companies that build financial architectures capable of growing through macro headwinds, rather than relying on temporary spikes in global ad spend. We need to trace their performance back to financial year 2022 to verify that this is a sustained operational trend. On this 5-year bar chart, top-line revenue shows a steady climb, compounding at 25.8% annually through FY 2026. But notice the trend line overlaying those bars, their EBITDA growth. At a 30.1% compound annual rate, it rises faster than the revenue itself. Expanding profit margins faster than the top line over 5 years proves massive operational leverage, extracting more cash from every rupee. Zooming into the final quarter confirms this. In Q4 FY 2026, revenue and EBITDA both jumped by 20.3% year-over-year. This raises a very immediate mechanical question. How exactly is this platform scaling its revenue so aggressively without driving up the underlying operational costs at the same rate? The answer lies in their tech stack. This margin expansion indicates a reliance on an increasingly efficient software and AI ecosystem to generate returns, avoiding the trap of brute force ad spending. To understand that efficiency, we need to shift our focus away from the size of the revenue and examine exactly where it comes from. Affle has structured its entire client base around a strict verticalized framework they call EFGH. This matrix breaks down their target industries: E for e-commerce, entertainment, edtech. F covers fintech, FMCG, food tech. G is gaming, government, groceries. And H spans health tech, hospitality, home utilities. 100% of Affle's direct customer revenue flows exclusively from these resilient blocks. Traditional ad platforms often rely on volatile sectors that slash marketing budgets at the first sign of an economic downturn. By restricting its focus to everyday consumer needs, like groceries, personal finance, and healthcare, Affle targets sectors with high customer lifetime value that require continuous engagement, regardless of market conditions. This establishes a baseline floor for ad activity. Concentrating their client architecture entirely within this EFGH framework effectively builds a structural moat. It insulates their unit economics from the wider macroeconomic shocks that routinely disrupt the broader advertising market. Knowing which industries they target, the next step is mapping exactly where they deploy this framework globally. This breakdown shows their revenue distribution for Q4 FY 2026. The deployment heavily indexes toward India and other emerging markets, which generate 71.6% of total revenue, leaving developed markets at 28.4%. This concentration is highly intentional. It allows them to capitalize directly on the aggressive, ongoing mobile digitalization taking place across emerging economies. To extract revenue from these specific markets, Affle relies on their core operational engine, the cost per converted user, or CPCU, business model. This graph tracks their operational volume, showing a continuous climb in user conversions from 68.7 million in Q1 FY24 to a record 120.3 million by Q4 FY26. Aggregating these quarters reveals a staggering 456 million total converted users in FY26. The mechanism driving this volume is straightforward. Under the CPCU model, the client does not pay for passive impressions or generic clicks. They pay strictly for hard, measurable actions, like an app installation, a purchase, or a registration. By pairing high-growth emerging markets with a strict pay-for-action model, Affle aligns its own revenue directly with its clients' success. The platform only scales when it delivers real-world business outcomes for its clients. Processing 456 million hard conversions and maintaining a 30% EBITDA CAGR over 5 years requires a sophisticated processing engine. This brings us to their Affle 3I vision framework, built around innovation, impact, and intelligence. Looking at the intelligence pillar, the engine relies on Affle AI and dedicated agents to enhance productivity and generate hyper-contextual creatives at exponential scale. That algorithmic intelligence translates directly into the impact pillar. This is exactly how they maximize measurable business outcomes and drive 456 million consumer actions within the EFGH sectors. The financial yield of this AI-driven impact is clear in the final reporting. It generated a Q4 EBITDA margin of 22.3% and pushed the total profit after tax for FY26 to 4.54 billion rupees. Moving the ad tech model away from selling passive inventory and toward delivering AI-driven, actionable intelligence changes the financial math of the company. It replaces the volatility of marketing budgets with the consistent unit economics of a software service. This decadal growth is the engineered outcome of a conversion engine designed to compound value regardless of shifting market winds.